Welcome everyone. This is the third part of our three-part webinar series. In this one, we're going to be covering everything ABLE accounts and special needs trust, when to use them and how to use them most effectively. I've had a lot of fun with you on this journey covering across the three webinars, the typical financial roadmap families with special needs experience from a 30,000-foot view. And in that webinar, we at a very high level touched on SSI, SSDI, ABLE accounts and special needs trust, but not diving into the specifics, but really looking at it. Where do those various programs come across in your lifetime? The second webinar, we covered everything Social Security, covering traditional Social Security and earnings-based Social Security, as well as Social Security disability insurance and SSI, and how you as a parent may be able to impact your child's Social Security benefits. And now this one being the last one, which is ABLE accounts and special needs trust, the financial vehicles that are available to protect you, your means-tested government benefits. Like the first two webinars, this will be recorded. It is up on our website. You can find that by going into the Insights Video Resources section of our website. Or if you go to YouTube, you can type in Van Holzen Financial Advisors and you will see it there. And we'll also be sending it out via email. Everyone that has RSVP'd to this webinar series, we've included in our newsletters. We send newsletters out monthly that covers a range of topics on special needs planning. We will have a Q&A section at the end. I have my colleague Andrea monitoring the chat, as well as the questions that came in when you RSVP'd. So during the webinar, feel free to send questions through the chat and we'll go over them at the end. Great. Let's dive right in on this. So my name is Rhett Beal. I am a partner of Van Holzen Financial Advisors, and like the first two webinars, I am your host. And I am a financial advisor for high net worth families with special needs and helping parents like yourselves ensure you have enough financial resources for your lifetime as well as your child's lifetime, utilizing private and public resources available to you. I think it's important to understand why I created this niche, why I'm doing this webinar series, and my heart behind it. Several of you have already heard my story, but it all started with my brother-in-law, Jordan. Jordan is my wife's twin. And unfortunately, Jordan had a brain tumor at age 5. And battling the brain tumor, the cancer, the surgery, the chemotherapy, as well as some other health issues that has come along in his lifetime, it significantly stunted his growth and development. Jordan is a ton of fun. We absolutely love him, but he will need some form of lifetime support. And my mother-in-law, just like many other parents' biggest concern is who's going to help Jordan after they can no longer do so. And that started the conversations with my wife and I, where we agreed to be the ones to take Jordan in. And as the financial advisor that I am and kind of a planner, someone that wants to be prepared, I thought I was in a good position to do that. But what I quickly learned is I had no idea how to put together a special needs plan or the financial elements involved with it. And I also learned that I was not alone, and that only 6% of families have a coordinated and communicated plan. And that 6% really broke my heart. So I decided to dedicate my career to help families like mine with sound financial advice. I know some of you may be able to afford my traditional services and others may not, right? So this is one way I'm trying to give back. So regardless of your financial situation, you can learn more about the financial tools and resources available to you so you can make wise financial decisions for your family. And all I ask in return is that you pay it forward. Share the information you learn here and also let others know that I'm here to help them with their specific situation so that we can help more families be prepared for the future, right? And we can take advantage that are available to us, right? And these resources that are available to us. And how are we going to cover today's webinar series on ABLE Account Special Needs Trust? We're going to dive into the ABLE accounts. What are the benefits of them? What's its intended purpose, as well as their limitations? We're going to go into special needs trust, the various kinds of special needs trust, and when to use each kind, as well as financial planning techniques or thoughts or considerations for families with special needs. because it is unique. Most of our peers don't have to think the way we do, and so it requires a different mindset. And I want to give you some of those tools and framework to be able to think about it. But remember, this is just a framework, right? This is not specific tailored advice for any individual, right? I can't do that in a webinar series as everyone's situation is unique. So if you have or would like specific advice, please reach out to me. Reach out to me via email or our website or give us a phone call, right? So first up is ABLE accounts. ABLE accounts were very intentionally created for people experiencing disabilities, right? The government had a decision to make to loosen the rules and restrictions around mean-tested benefits like SSI, or create a resource vehicle specifically for those experiencing disabilities. You can see which path they chose, right? They didn't lift the SSI income limit of resource limit of $2,000. And so we welcome in the ABLE program, which is a very intentional acronym that stands for Achieve a Better Life Experience, right? Achieve a better life experience through a tax advantage savings account for individuals with disabilities that are regarded as an excluded resources for means-tested government benefits, right? What are means-tested government benefits? They're programs like SSI, Medicaid, food assistance programs, Section 8 housing, and other state and federal programs that look at one's resources, right? SSDI or Social Security Disability Insurance is not one of those programs, but SSI, Medicaid, food assistance programs are. Right, and this is why I really like the ABLE accounts. They're a great tool to help us store excess savings above those strict $2,000 SSI limits to support one's daily living needs, right? I consider these to be like souped up savings accounts and tax advantage savings accounts. Additional benefits that exist for an ABLE accounts, they're really easy to open. Right, you can go into your state's ABLE program in California, right? It's called the CalABLE. Every state has their own ABLE program, and you don't have to open the ABLE program in your state. If you live in Nevada, you can open it in California. If you live in California, you can open it in Utah. It does not matter, but you can only have one ABLE account per individual. You cannot have multiple ABLE accounts per individual. There are no setup fees, right? No annual tax returns. And another great benefit is anyone can contribute to it. Doesn't matter if it's the beneficiary, the parents, the siblings, the aunts, uncles, friends, anyone can contribute to it, but it is cash only, right? And the gains in the account grow tax-free, and you can distribute them and use them tax-free, just like a Roth IRA account. When you use them for what we call QDEs or qualified disability expenses, right? And it's important to think about it like a Roth IRA account. You are not putting in pre-tax dollars, you're putting in post-tax dollars, but all the gains, once they're in the account, can grow tax-free. And you can put them in investments that have more growth orientation to them or safer, more interest related. And you can have access to prepaid cards. A lot of people, when they come to me, say, yeah, but I'm concerned because my child doesn't necessarily understand that just because they get money doesn't mean they have to spend the money, or that it's difficult for them to understand the value of one thing versus another may not be the same. And this is where prepaid cards can really come in handy. You can set spending limits. For example, say you want to fund it with just a couple $100. Well, then they can't spend over a couple $100 using that prepaid card. You can set up, hey, they can use this money on this type of service or good, but not this type. There's a lot of flexibility around them. And if you built up money into a 529 plan, you can start rolling those over into an ABLE account. Even if it's to a different individual's name, you can roll them over into an ABLE account. But there are some limitations to it. Right, one of the key limitations are you can only contribute up to $18,000 per year. And that's the same thing with those 529 plans. You can only roll over $18,000 per year into it, with a couple exceptions. The one exception is if you or your child or you yourself have an ABLE account and you are working, then you can contribute your work income into the account. And I see I missed a zero on that 14,580. It's supposed to be 14,580. I missed a zero. I'll correct that. But you can contribute 18,000 plus the lesser of 14,580 or your annual earnings. But there is a restriction to that. If you have an employer-sponsored plan, you cannot go above that $18,000 amount. Another limitation is only the first $100,000 is seen as an excluded resource for mean-tested benefits. So if you are not utilizing mean-tested benefits or your child's not using mean-tested benefits, you can go above $100,000, and the limit's $529,000, quite a bit. It's really difficult to get there when you can only put $18,000 in per year. But really, only that first $100,000 is seen as excluded. That's why I call it kind of the souped-up savings account. And another limitation is there may be a Medicaid payback provision. This is not the same in every state. Every state has a little different rule. California is a state that says that there is not a Medicaid payback provision on it, where most other states do. But unfortunately, you can't name a beneficiary directly on the ABLE account, which means it will flow into someone's estate. So like my brother-in-law, if he had an ABLE account and he passed away, it would flow into his estate. And then if his estate was small enough, he could sign a small account affidavit and not have a Medicaid payback. But if the estate is above a certain threshold, then even in California, even though the CalAble program says there is no Medicaid payback, they may have a Medicaid payback. It's confusing. I wish it was not so, but it is. And also within an ABLE account, you don't have as much customization around the investments. So if you go and open a CalAble account, any ABLE account, they'll have a preset investment menu for you that you can select from. Usually there's about a handful that they'll categorize as conservative, balanced, or growth oriented. And you can really look at what is right for you and your family. And then another limitation, or actually I just call kind of a nuisance, is it is highly recommended that you keep record of all the distributions, right? And I want to cover what is a qualified disability expense. That's really crucial because we said you get the tax-free benefits as long as you're utilizing the account for qualified disability expenses. And you'll notice that the definition is very, very vague, right? It is expenses for items or services needed to maintain or improve the health, independence, or quality of life for people experiencing disabilities. I want to let you know that it was intentionally drafted to be vague to make it not too difficult or limiting in its actual use, right? Though most of us have experienced most of government benefit programs, there's so many rules and limitations, and it is very difficult to understand what can I do and what can I not do. This program was designed to try and remove a lot of that and make it more simplistic. And that's why I like to call it that souped up savings account that can pay for goods and services needed to maintain or improve the health, independence, and quality of life, right? And so I'll give you some examples of what those are. Education, housing, transportation, buying and maintaining vehicles, employment training and supports, right? And the list goes on and on. I'll let you look at that list for yourself. You can use these for vacations, and you can use them for general food and going to the movies. There are a lot of ways you can use this account to help pay for just daily living and to enhance quality of life, which is really great. I'm a big fan of these. And the next question is, who qualifies, right? If these are so good, who qualifies, and is it for everyone, or is there some restrictions around it? There are some qualifications, and the first one being, right, there has to be a medically determinable physical or mental impairment, which results in a marked and severe functional limitation that has lasted or is expected to last at least 12 months. Right, that's really, really important. Has to have lasted or expected to last at least 12 months. And it's highly recommended that you have a letter of certification from a licensed physician saying that those disabling conditions exist. if you're on SSI, your child's on SSI, that's null and void. You already have that documentation and it's proven. You don't need to worry about it. But if you or your child is not on SSI or SSDI, I recommend that you have a physician note, and this also counts for, let's say, a paralytic who needs to utilize a wheelchair but is fully able to work, and have sufficient gainful activity and provide for themselves. That is a physical impairment, and you can utilize an ABLE account, or your child can utilize an ABLE account. It does not mean that you can't work, right? As we showed, if you work, you can actually contribute more funds into this beyond the $18,000 limit. The key, though, is the disability onset has to be prior to 26 years old. So unfortunately, if there is a car accident at age 27, they would not qualify. But if the disability onset was prior to age 26, you qualify today. Good news, in the year 2026, that age limit is moving up to age 46. Why they did not just move it to 46 now and they're waiting 3 years from when they originally said they were going to move it, I have no idea. Sometimes what the government does doesn't make any sense to me, but that's just the letter of the rule and the law, right? And like I told you, this is a federally mandated program, but each state is in charge of overseeing it. And at the state level, most of these states actually hire out a private company to oversee it on their behalf. And when you go open an account, you're not going to have someone come to your door to verify that you fit all these qualifications. It's actually really easy to open an ABLE account. They might ask and give you some general guidelines, hey, is there a medically determinable physical or mental impairment? Yes, right? It's a simple Q&A, and then you can open the account. The key is, though, and it's important for you to know this, the burden of proof is on you that there is a disabling condition. Excuse me. And the only time you'd really have to prove this is if you ever got audited by the IRS. Notice that I said the IRS. And that's because the ABLE account program is falling underneath the favorable tax codes. So it's overseen by the IRS. And so if the IRS ever came to audit you, one, you would need to prove that there is a disabling condition, whether it be a physician note or through SSI or SSDI. And two, you would need to prove that the expenses what you're paying or using that money for is only for the child with disabilities, right? So let's just say you go on a family vacation, your child has an ABLE account. Your child can use the ABLE account to help pay for the hotel room or pay for their Disneyland ticket. They can use it for those benefits, but the ABLE account money should not be used to pay for your Disney tickets or your stay in a hotel room, right? It could be used for, let's say, there's an alternative caretaker who supports them, and they have to go along with you or your child so that you can go to Disneyland. Well, then the ABLE account program can pay for that. Technically, it could be used for a parent. You could justify it, but I'm going to tell you, I wouldn't risk it. And it's just not worth risking it. Have them pay for their specific portion, and then you pay for your specific portion, right? If there is a third unrelated party who needs to go along with them, sure, that is a lot clearer and less to justify and makes total sense. But if it's a related party like you or as a parent, be really careful on that and really stick to the rules and guidelines that the resources in the account are for the benefit of the person with a disability. All right, that is everything on the ABLE accounts. And I want to make a shift over to special needs trust. Right, a lot of us hear about special needs trust, and they are a little bit different than the ABLE accounts in that they are a special kind of trust that helps preserve or pass assets, wealth, and income for an individual with special needs without eliminating their eligibility for means-tested government benefits. That sounds really similar to an ABLE account, right? Well, let's look at their similarities and let's look at their differences. We're going to look at them side by side. First, we're going to look at their similarities. They both protect government benefits, and when we talk about protect government benefits, we're talking about programs like SSI, Medicaid, food assistance programs, Section 8 housing, right? Those means-tested government benefits, not other programs like SSDI. It also helps protect from creditors. They are specifically designed for people experiencing disabilities, and they both have growth capabilities, right? That is what they have in common, and what they have different from one another. And I'm going to jump kind of back and forth, and you'll see I lined these up top to bottom. The ABLE accounts, tax-free, right? Special needs trust, they're taxable. ABLE accounts, no tax return. Special needs trust, there may be a tax return, right? You will need to file for taxes on it, on the income and growth and capital gains there. ABLE accounts, only $18,000 can go into it per year unless you're working, and then the limit's a little higher. For special needs trust, there is not a limit, right? So it's a great tool and resource for those larger gifts and inheritance. ABLE accounts, only $100,000 is excluded for those means-tested government benefits. Excuse me, I got allergies. And special needs trust, there is no max account balance. It can be $1 million, $2 million, $3 million. It can be much higher than those ABLE accounts. ABLE accounts, really limited customization. And what I mean by that, particularly for the types of assets that can go into it, right? ABLE accounts are cash only, where special needs trust can have just about any asset type in it, whether that be a business, real estate, stocks, bonds, Bitcoin, or really just about anything can go into that special needs trust. And there's a lot more flexibility of what you invested into. ABLE accounts, there's not any setup expenses. There are underlying expenses to maintain the account. They're really little, right? And a lot less expensive than a special needs trust, where a special needs trust has setup expenses traditionally working with an estate attorney, likely going to cost about $5,000 to do your trust with the special needs trust component to it, to do it right. And, but a benefit of those special needs trusts is you can either self-manage or get professional management on them. Think of if you need a trustee fiduciary to help manage the budget and expenses, or if you need an investment advisor or a legal representative, where those ABLE accounts is really mostly self-managed and no other professional support there. I want to let you know that there are 3 different types of special needs trust. And I'm going to break down the difference between them so that when you hear people talk about first party, third party, or pooled trust, you know the difference. A first party trust is a trust funded by the individual experiencing disabilities themselves, right? So examples of this is, I'll use myself as an example. I'm working, I have savings, I have a retirement account that I'm building money, I'm saving into, and I get in a significant car accident, and now I really need to utilize Medicaid services, or else I'm going to spend it down because of all of my medical bills. Well, then I can open a first-party special needs trust and fund my current resources into it to try and protect them. That's one example. And another example is settlements. If I got that car accident and the other individual was at fault and there's an insurance settlement, it could flow into a first-party special needs trust. A third-party special needs trust is what most parents think about and consider. A third-party special needs trust is gifts from anyone else but the beneficiary experiencing disabilities. So think of like gifts or inheritance and things like that. And then lastly, you have pooled trust. Pooled trusts are unique vehicles. They can be first or third-party vehicles, but the difference is it's not a standalone, right? Where a traditional first and third-party trust that we think about, it's specifically drafted for one individual, and you can customize it in many ways, shapes, and forms. A pooled trust is many people coming together to try and minimize the fees to support those with smaller account balances, right? And these pooled trusts, you really don't get customization on the investment plan. They already have that predetermined. They already have predetermined that they're going to be the trustees. And so there are some limitations to it, but it's much cheaper to implement and can be a very valuable tool. Particularly, let's just say you want to pass on $50,000 to your child, but you need to spend $5,000 setting up the trust, and then you need to spend money on a trustee. Well, now you just use quite a bit of that money that you expected to go to them to just get it established, and they really didn't get the benefits out of it. Where if you have 250, 500 plus $1,000, it really makes sense to get that customization. But if you're below some of these thresholds, the pooled trust may be a really good tool for you and an avenue to go down. Right? I'm going to briefly cover this. I just covered some of it, right? When should I use it? It's really intentional to use it when you need to protect means-tested government benefits, right? That at the highest level is the most important, right? If you don't need to protect means-tested government benefits, my brother-in-law fits in that. He will need lifetime support, but he is working and paying into Social Security, and if he has more disabling conditions come on where he can no longer work, he'll be on SSDI, right? Which is not a resource limitation, and he's already on Medicare. So he's getting that healthcare services. He can have a unique type of trust where he gets that extra support, and we can assign trustees or powers of attorney to support him, but it doesn't need to be as strict as a special needs trust, right? So if you need to protect those mean-tested government benefits or want to protect them, which is really mostly for those who are unable to earn that substantial gainful activity or sufficient wages to provide for themselves, this is a great tool and avenue, right? Times to use it, gifts, particularly gifts over $18,000, right? If you have a gift that you're giving to your child or someone wants to give to you that's below $18,000, look at utilizing an ABLE account because it's cheaper, right? And it's more flexible, and you can get that prepaid card and you can pay for expenses directly like any other debit card. But if you have gifts larger than $18,000, great resource. Next one is settlements. Like I said, an insurance settlement, great resource. Child support payments. If you are going through a divorce or some divorce coming in the future, and either the husband or wife is required to pay child support, which is very common. It's very common to happen long past the child turning 18 years old. We don't want to give the money directly to them because it can impact the income and resource limits, providing that are making them eligible for the mean-tested government benefits. That's where we want to open up a special needs trust and work with the attorney so that those child support payments are going directly to the trust, not to the individual. And lastly, inheritance, right? Those are a few examples. One great thing about special needs trust as well is it can help assure that the assets are being used what they're intended for. There are a lot of rules, rules and regulations around how trusts are managed, and you can put very strong language in the trust to ensure that that money is using specifically for its intention rather than some other avenue where it gets spent away from where you hoped it to go to support your child with disabilities or you yourself. And like I said just a few moments ago, you can hire professional support. You can't do that with ABLE accounts, and often professional support is really valuable, whether it be helping with the investments and the financial planning to make sure that the money inside the trust is going to last for the individual's lifetime. It could be legal services to make sure that the money is being used as it's intended. Or let's just say the laws change and we can change the verbiage inside the trust. We can use an attorney to help change that language. And as well as trustee fiduciary services, which are individuals who help with kind of managing the daily expenses or monthly expenses. And the fiduciary can work with investment advisors as well as attorneys. And fiduciaries, trustee fiduciaries come in handy, particularly if, a sibling or another individual that you highly, highly trust.
Got to his house. But then when we got to his house, I was like, well, I don't want to say too much. It's
not
his
on
house,
you. Thank you. Someone that you highly trust to be able to help oversee that. You can hire a trustee fiduciary who is legally obligated to put the best interest of the individual ahead of their own to do so. Right? So what are some common questions that come to my desk on special needs trust? How do I start a special needs trust? Like, where do I go? It starts by going to an estate attorney, and I highly recommend going to an estate attorney that has a niche in special needs planning. just because they know the rules and regulations around the government benefits and how to structure that trust properly. And typically it will be getting the estate plan for you as the parent established. And then the special needs trust will be set up like what we call a testament trust, which means it won't open or fund until after you pass away and in your estate. Can you use a special needs trust to fund an ABLE account? The answer is yes, and I actually recommend doing this to help pay for daily living expenses. Because with the special needs trust, we really don't want to fund the money out of the special needs trust directly to the individual. You just start running into income and resource problems. And usually with the special needs trust, you want to pay for the expenses directly. So let's just say, you have a child living in a house that's owned by the special needs trust, and the special needs trust is paying for utilities and property taxes and everything directly, right? They're not sending the money to the individual experienced disabilities bank account and then they're paying it. The trust is paying it directly. But for things like food and going out around town or to the movies, it's really helpful if the trust funds the ABLE account, and then the ABLE account is able to open up that prepaid card or that debit card where they can use it for the movies and food and other resources. Really valuable and a great technique to make sure that you're still protecting those means-tested government benefits. And can you name a contingent beneficiary on a trust as another key question? The answer is yes. And some of it depends on the type of trust. If there's a first party special needs trust, which is funded by the individual themselves, there are Medicaid payback provisions. And so Medicaid is going to be the first one to get paid back for all the services that they paid for. And then if there's any excess money over and above that, then it'll go to contingent beneficiaries. Third party special needs trusts don't have Medicaid payback provisions. Really valuable. And so you can assign your child with disabilities as the primary beneficiary, and then if something happens to him and there's extra money in the account, you can, as the parent, assign a contingent beneficiary. Really helpful. For pooled trusts, doesn't matter if it's a first party or third party, more often than not, because these pooled trust accounts are smaller, they're keeping the money and they're using it for other individuals who need it. So they'll spread it out amongst others inside the pooled trust for their benefit. So it's unfortunate that it's not going to someone that but they traditionally are going to someone else who needs it and doesn't have those additional resources over and above, right? So great tools and resources, but know whether it's first, third, or pooled trust, what will happen with that money. I want to make a shift, right? Because we're talking about ABLE accounts and special needs trusts. ABLE accounts traditionally being those souped up savings accounts that can pay for, daily living needs. The special needs trust is kind of the safety net to capture large gifts, inheritance, child support payments, as well as settlements. But it doesn't help solve kind of the planning for special needs funding and how much do you need to go into those accounts, right? They're just storage vehicles and they're going to be empty until you fund it. And the question becomes, how much do you put into it and how much do you have to put into it? And I call this planning for special needs families. This is what I do, right? I'm a financial advisor. I do financial planning, and then I help people align an investment strategy to achieve those goals and objectives, right? How do you make sure that the parents consider themselves in their financial plan, as well as think about their child? And so when we do this, the traditional financial stages of life come in three forms, right? All of us, we have our working years, we have our retirement years, and then there is our state. And during our working years, right, it's designed to pay for bills, do things that we really enjoy, and then accumulate enough income producing assets to live off of during our retirement years, right? And depending upon our means and our expenses, we traditionally have three scenarios that can happen in retirement. One, our asset base can continue growing. That's great. Second, our asset base can remain stable and flat, where the income produced off of it pays for all of our expenses. And then lastly, we spend down that asset base throughout our lifetime. And then whatever goes into the estate really is just a gift, right? This is how most of our peers think about their financial stages of life. And whether their kids get money or they give money to a charity, it really is a gift, a cherry on top, and something that is heartfelt, right? But for families with special needs, it's often not a gift, it's essential. We still experience the financial stage of life of our working years and our retirement years, but our child, particularly if we have a child who is unable to earn sufficient or sustainable income for their expenses and need additional support, it's essential. And the question becomes, how? How do you plan for your lifetime and the lifetime of your loved one? Or sometimes what I like to ask, what is your retirement special needs trust funding plan? Just because you went to an estate attorney and got the documents drafted doesn't mean that the trust is funded. There's nothing in it, right? And so we have to really plan through how much money is there to go into the trust or into the ABLE account. And even more importantly, how much money will your child need based on their capabilities, right? And the resources they need to supplement their life. These are really difficult questions to answer, but I want to let you know there are people out there who can help you do it, right? This is what I dedicated my life to do, so I am one person who could do it. There are some other financial advisors out there that can do it. If you have a financial advisor, great. If you are looking for a financial advisor, I recommend going to one that has this niche. You know, I was that individual who was working with high net worth families, was knowledgeable in financial planning for the traditional families. I had no idea how to do a special needs plan. I had to learn that, and it is a unique niche. So make sure you're working with people that understand how this works so that you can maximize your resources, right? And when we're talking about maximizing resources, we're talking about how do we provide financial security? And for the financial security, moving on from here, I'm going to specifically talk about it for your child, right? In this webinar series, we aren't going to be able to go over maximizing or providing the financial security for the parent. You know, that is a whole other conversation that we can talk about if you want to. But for now, we're going to talk about it for your child. And I like to think of it as sitting on a teeter-totter. The more private family resources there are, the less we need to rely on government assistance programs. And vice versa. The less private or family resources there are, the more we need to rely on government assistance programs, right? And the types of private resources can include, you know, savings. Think of retirement accounts or savings in trust accounts or individual accounts, joint accounts. It could be investments. This can be a private business. If you want the earnings from the private business to flow into, say, a trust to provide that supplemental income. It could be real estate, whether it be rental real estate or just the primary residence that your child lives in. It could be life insurance, right? You can pay for life insurance to ensure that there's a certain pool of money going to your child. It could also come from annuities. You know, if you are accumulating into an annuity now, there are ways to be able to assign beneficiaries, or your child as a beneficiary. For the public resources, these are things like Social Security, SSI, SSDI. There are things like Medicare and Medicaid, right, to make sure they got the essential healthcare resources that they need. It could be food assistance programs, Section 8 housing, right, and other government benefits. You know, in California, we call it the regional center. The regional center has a lot of benefits. And I know people that are getting over $100,000 a year from these resources to support their child, you know, significant amount of money. So when we're looking at it for your child, we want to balance these two out. And the more private resources you have, you know, the more flexibility and choices you have of whether or not you want to, you know, fall in line with the means tested rules. And then the less that you are able to pass on, the more we're really going to want to focus on those government benefits to ensure that protection so that, one, your child's protected, but also you as the parent can ensure that you have money for your lifetime too, because it's likely, particularly if you don't have disabilities and you've been working, you aren't going to get all these extra benefits that your child's going to have because of the disabling condition. So for you as a parent, you do need to think about yourself and say, How do I make sure I'm utilizing what's available across the whole spectrum and balance the two out for yourself and your child, right? And that's how we're looking at it here, particularly if you have a child who is unable to earn that substantial gainful activity. So next I'm going to cover kind of splitting the assets, and this is really looking at it from an estate plan and looking at if you have, say, multiple children, and we're going to go through the Jones family as our example. And for the Jones family, they got 3 kids, 2 without disabilities and are working, and 1 with a disability. And in this scenario, I'm going to say is unable to work. And when most people come into my office, this is kind of the estate plan that I most often see. Parents come in, they tell me that they've insured nothing is in their child's name with special needs to protect their government benefits, with the expectation that the other siblings will step up to support their brother or sister, right? And you can kind of see that where of the estate, 50% is going to Jade and 50% is going to John, and Spencer, who has special needs, has been disinherited. There are significant risks to this. I talked about it a little bit in the first webinar. I want to cover it again, right? The risks are, one, you're putting a lot of expectations on the other siblings, right? And time expectations. What happens if they're raising their own family? What about the relationship between the siblings? Would they be able to step into a parent-like role, or would it be better for them to be in a sibling-like role? You know, those are important considerations. What happens if one of the other siblings or both the other siblings get in a divorce? Assets split 50-50 after a divorce. Now those resources that were expected to go to, in this example, Spencer, just got split in half. That's unfortunate. What happens if one of them passes away and then it goes on to their estate, and those individuals are less inclined to support your child with disabilities, or in this case, Spencer? That'd be unfortunate, right? And then we get into things like lawsuits. If there's a lawsuit, that lawsuit can go after all the assets of John and Jade, right? And now the assets that were supposed to be for Spencer are no longer protected because they're not in the special needs trust type vehicle where it's protected from creditors, and those assets are gone. What about bankruptcy, right? If things get difficult, credit card debts go up, those resources are going to be spent down to help cover the debts. All things that are significant risk to Spencer. So I highly recommend you don't do this, and instead take the time to properly set up the ABLE accounts and special needs trust to ensure your loved one with special needs gets the resources needed without having all that risk on the other siblings. And this is highly customizable depending upon your personal situation. Using the Jones family as an example, it can look like this. You know, and this is very common. Most families do this where they split the assets equally. Here it would be a third, a third, a third. But we don't want everyone to look at their situation, you know, in parallel or the exact same. Everyone's situation is unique and different, right? And there are families that have significant resources where maybe Spencer shouldn't get the same amount of money as Jade and John because it's far more than he needs, right? And so Jade and John may get more of the estate and then those assets, you know, pass on to their children, where Spencer has sufficient amount for his lifetime, but not way more than he needs. Or you may want to consider giving 100% of the estate to Spencer, right? And Jade and John get the heirlooms. That is one consideration. But the key is, regardless of how you split the assets, equally or not, it really depends on your personal situation. And the keys to success when you're thinking about passing assets on to the next generation, first and foremost, comes down to communicating. Communicate, communicate, communicate to the family. Your kids want to know what the plan is and what is expected of them. And they also want to have a say how they're involved. Invite them in where they want to be involved. This is where my family was, right? So I completely understand this from a personal level, and I guide many of the families that I support doing this because For me, I wouldn't care if my in-laws gave all the money to Jordan if Jordan needed it, because I am able to work, right? And I am able to save for my own retirement, and I can take on that discipline. But knowing that Jordan is cared for is more important to me. And then looking at the heirlooms, maybe there's some wedding rings, or maybe there's other important things at the house that you can pass on. That's far more meaningful than the money, right? So don't see that as a limitation because the money has to be equal. Look at your personal situation and communicate to the family, right? That is the first key success and the most important. The second one is take the time to work with a financial advisor with the expertise in special needs planning, right? Who can map out the financial plan for you. How much do you need for your lifetime? How much do you expect to go to the next generation? How much do you need to lean on those government benefits versus your private resources being enough, right? That can be mapped out so you have the clarity, and also there can be an investment plan to help you achieve those objectives. The third key, work with an estate attorney to make sure that the estate plan is set up. Make sure that you get the special needs trust set up. We don't want this to go into probate. Probate is a long, grueling process, and the money will not go where you want it. I told you early that setting up your trust documents may cost $5,000. That is a lot of money. But I'll tell you, going through the probate process is far more expensive and will be far more expensive than that $5,000 that would have gone through. And also the probate process, because it has a massive backlog, can take a year, 2 years, 3 years, depending on how complex the estate is, to settle out before the money even goes to the next generation. So I highly recommend to avoid the probate process, particularly in California. I'm from California. It has probably the most strict probate rules. There are other states like, and I won't name them specifically, where a will does enough. And if you're in that state, right, your estate planning attorney will give you that direction and guidance. But if you're in California, I highly, highly recommend going to the state attorney and make sure that they have a niche supporting people with special needs so that they understand the government benefits that you're trying to protect. And I know this is a significant amount of work, right? Doing this is more work than our peers have to go through, but it's imperative that we take the time to do it, that we do it while we still have enough energy and we're young enough to make sure that the plan goes right and that's all established, rather than making it a rushed emergency or something happens and you're no longer able to verify it goes right, because we cannot afford not to, right? We can't afford to take the risk for it not to go right. And we need to make sure that our loved ones are cared for, provided for long after we're gone. And that's where Able Accounts and Special Needs Trust can be a valuable tool and resource and a storage vehicle for you. Thank you, everyone, for listening on this 3-part series. I do want to remind you that this was recorded. You can go back and rewatch it. You can reach out to me if you got questions. You can go to our website and look at our resources and newsletters and blogs. And I do want to open this time right now for Q&A if anything was sent in through the chat. So Andrea, take it away.
We had some good questions come in with the RSVPs. One of them was, what happens to the proceeds of an ABLE account if your child passes away?
Yeah, good question. It depends on the state. We briefly covered it. Most states have a Medicaid payback provision first, and then it goes into the child's or the individual's estate, and then however the state decides to distribute those funds. Even if you're in a state like California that says there are no Medicaid payback provisions, there still may be, right? It is misleading, and it may go into the state. And if the estate is large enough where they cannot file for a small estate affidavit, then there may still be a Medicaid payback. But if it's below those small estate affidavit levels, then you can name the beneficiary through that individual's estate specifically.
What would you suggest is the best time, based on the age of the child, to start talking to a financial planner?
Great question. Completely depends on your financial situation, right? And there's these life stages that we experience when we have loved ones with disabilities. I would say first and foremost, let's just say you just learned that you have a newborn and you learn that they have a disabling condition, they're really young. The first thing I would look at is making sure your estate is set up and life insurance, right? Because most parents in that stage of life are still accumulating wealth and don't have major nest egg savings. But if you are someone that did inherit a bunch of wealth or have already earned a bunch of wealth, you can work with a financial advisor right then and there. That'll be crucial to make sure you get the structure right. And moving along that kind of timeline, then as your child starts becoming, closer to 18 years old, you're starting to be curious around how do you apply for SSI? Are they eligible for SSI? That is a great time to work with a financial planner. And also it's the time to make sure it is you as the parents are probably getting, into the 40s to 50s to look how close are you to retirement. So there's not an exact age. It really depends. But I would say don't wait too long. As you're getting closer and closer to retirement, really look at it and be careful. Really make sure that you have those protections in place, because any one of us can get in an accident and pass away at any time. It's unfortunate, but things happen, and we want to make sure that we have the safety nets in place. So the sooner you start the communications, the more at peace you will be, and the more at peace your family members will be, because everyone will know what to do. And that's really crucial to make sure that things go smoothly in transitions, because we know most of our family members with disabilities, transitions are really, really difficult. And so the more we can pre-plan, the smoother that will go.
Somebody had written in saying that they already have a special needs trust and they want to know if there have been any changes to the laws over the last 10 years.
Yes, great question. I highly recommend that you check in with your estate attorney every few years to verify that the trust is up to date with the latest laws. Over the last 10 years, I'll give you an example of what's happened over the last 10 years that is a benefit to families with special needs. Roughly 10 years ago or so, the trust language was very, very restrictive. And you would see language in there that says, do not use any money to the individual if it impacts government benefits, right? So for example, hey, the government, Medicaid and Medi-Cal does not provide the proper wheelchair, and you can use some private resources to go find the one that fits more accurately. There's some trust that will restrict you from doing that, and that's part of the old laws. The new laws are much more favorable and allow you to be more flexible, and you want to make sure that there is that discretionary verbiage in the trust. So getting that set up properly so that the trustees who are helping oversee the trust can have that flexibility, even if it impacts the government benefits, right? Because let's not hold our children back from getting the highest quality of life possible if you got the resources to pay for it just because a government benefit, a means test or restriction is in place. So good question. Yes, keep on top of it every few years to make sure it's up to date with the latest laws.
Another great question about the taxation element of this. So how are special needs trusts taxed?
Good question, and a difficult question to answer because it depends. It depends how the trust was funded and the life cycle that the trust is in. I'll say if it's a first-party special needs trust, which was funded by the individual themselves, they'll be taxed at personal tax rates. And I got good news. How SSI views income versus how the IRS views income for tax purposes are completely different. So, if I funded a special needs trust because I had a car accident and I got a settlement of $1 million, just because that $1 million had interest in dividends of $50,000, I might be taxed on that $50,000 at personal rates. But for SSI purposes, that $50,000 was all part of underneath the excluded resource of the special needs trust. So they're completely separate. And so again, first party special needs trust, excuse me, tax the individual rate and the preferred rate. A third party special needs trust, It depends. If you fund a third-party special needs trust, which remember is funded by anyone else but the beneficiary, it could be taxed at personal tax rates if you fund it during, let's just say you parents, you fund the special needs trust during your lifetime. A lot of people with large estates do this to try and maximize the state tax exemptions. And then you can have, because it's still open during the lifetime, you can make it what's called a grantor trust, and a grantor trust is taxed at personal rates. Often these third-party special needs trusts are not funded until after the parents pass away. And in that scenario, it's what we call, right, an irrevocable trust, and typically is taxed at irrevocable trust tax rates. Unfortunately, those tax rates suck. They're not as good or favorable as personal tax rates, but there are ways in which to manage that trust to keep the tax rates lower, such as like utilizing municipal bonds or when you pay for expenses and distribute the funds, that helps reduce the taxable income seen inside the trust. So there are a lot of strategies around this, and that's where having the proper professionals on your team is important to maximize those resources to allow them to go further. Good question.
Okay, and then we'll wrap it up with this one last question, and that is, what do you do if you don't have any family members to help oversee the trust?
Yeah, really, really good question, and really challenging and scary for parents to have to bridge that gap. My recommendation is to hire a trustee fiduciary to help you do it. Now, two different ways. If you have a smaller estate, and you might pass on $20,000, $50,000, $100,000 to your child, look at the pooled trust option. It's a great option. It's cheaper than the standalone option. And they will have trustee fiduciaries in place to help make sure that your child is still eligible for mean tested government benefits, paying for the expenses, and just the overall well-being. And then you'll also want to tap into the other government resources available. In California, it's like the regional center. And it's really important here that you do this while you are young enough to make sure it's going right. The scariest thing is if you wait till you are incapacitated yourself or can no longer verify that everything goes right yourself. You're leaving it up to the air and the whim of other people who don't know your child. To me, I couldn't do that. And so I highly recommend that you start working on it early when you are capable, and that you are able to see other people caring for your child and make sure that they're doing it right. And part of doing it right is your child better than anyone. And there might be some quirks in there and situations that come up that how to handle it that another caretaker or individual doesn't, because they don't know your child like you do. But if you are there walking alongside them while you're healthy enough to do so, you can guide them through that process so that your child can see that they're going to be okay without you, and you can see that they're going to be okay without you. Right, that's a full trust. If you're going to do a standalone trust, if you have, going to pass on $500 million, you can hire professional and trustee fiduciaries, and there are companies out there to do that. Like what I do with my clients, and I let them know, because I know you and I know the family and I've had conversations with you, the siblings, I can help oversee the transition to make sure it goes as you intended, because I've talked with you about it, and it helps make that more smooth. So really, really good question. Very difficult to do, but crucial to do it and start that process. And it takes years to do. So starting sooner is better. Any other questions there, Andrea?
No, that's it for today.
Awesome. This is a really big topic. All three of the webinars covered large topics. I appreciate you coming along the journey with me. I know I'm not able to give very specific advice because in the webinar series, because everyone's situation is unique, but I hope that you learned a lot and can start seeing the foundation of how to put your plan together for your family to ensure the financial security of yourself and your loved one. Again, my name is Rhett Beal. I work with Van Holzen Financial Advisors. don't hesitate to reach out to me, lean in on the resources on our website, and keep a close eye on the newsletter and other resources that we send out. It was nice spending time with you, and I hope you have a good rest of your day.